You are 39 and your net worth is $1 million. You just applied for a business line of credit. The application took 4 minutes. The approval arrived in under an hour. No documents requested beyond what was already on file. A credit limit attached that would have seemed fictional to you 15 years ago. Your phone has a notification from a credit monitoring app you've kept since you were 23, back when checking your score felt like checking a wound to see if it was healing. You don't open the notification anymore. You know what it says. It said the same thing for 3 years. You are wearing a $40 watch and a t-shirt you bought 9 years ago. By the end of this video, you'll definitely see that credit bureaus don't evaluate you. They evaluate a pattern. And the pattern is built entirely from decisions that have nothing to do with how much money you actually have sitting in an account. You'll find out exactly what they're reading, and most of it isn't what you think. This is how the credit system sees you, from $0 to $1 million. Level 1, $0. You are 19 and you have no credit history at all. Not bad credit, no credit. A blank file, which sounds neutral and isn't. You apply for a credit card to start building history, the advice everyone gives without explaining the mechanism underneath it. You get rejected by 2 cards before a third. A secured card requiring a $300 deposit approves you. You put the $300 down. The bank now holds your own money as collateral to lend you access to your own money, charging 26% if you carry a balance on it. You read the terms twice before signing. You sign anyway because the alternative is staying invisible to a system that requires visibility before it extends trust. You buy a tank of gas with it. You pay the balance in full 11 days later, before the statement closes. This single action, small, deliberate, repeated, is the entire foundation of what happens over the next 2 decades. Your score after 6 months, 640. Fair, not good, but real. A number now exists where there was nothing before. You apply for an apartment. The landlord runs a credit check. The fee is $45, non-refundable, regardless of outcome. You are approved, but at a higher security deposit than someone with established credit would pay. 2 months instead of 1, an extra $740 you don't have lying around, and have to delay other things to cover. The first rule, at $0, the system doesn't see you as risky. It sees you as unreadable, and unreadable costs more than risky in almost every transaction you'll make this year. Level 2, $50,000 net worth. You are 24, and you have $50,000 across savings, a small investment account, and the equity in a car you own outright. Your credit score is 712. Good, not excellent. The gap between good and excellent at this level is invisible in your daily life and enormous in the fine print of every loan offer you'll receive. You apply for an auto loan to replace the car you've outgrown. The dealership runs your credit and offers you 7.8%. You also apply independently through your credit union the same week, who offers 5.9% for the identical loan amount and term. The 1.9% difference, over 5 years on a $24,000 loan, is $1,140. Nobody mentioned this gap to you at the dealership. Nobody at the dealership benefits from you knowing it exists. You also begin learning what utilization means, the percentage of your available credit you're actually using at any given moment. You'd been running your card near 70% utilization, paying it off but carrying balance through the month, not realizing the bureau reports the balance at statement closing, regardless of whether you pay it off days later. You drop your utilization to 12% by paying down balances before the statement cuts. Your score rises 38 points in 2 months without you earning, saving, or spending a single additional dollar. This is also where the habits underneath your spending start to matter as much as the spending itself. Because what the credit bureaus reward, structurally, is exactly the discipline that compounds in every other part of your financial life too. I broke down the full 10-year version of that discipline. What happens when you simply stop upgrading the phone, the watch, the wardrobe, every time a new version arrives, in the video appearing right now? The math there and the math here are the same math, just measured in different units. But for now, let's look at what changes once your net worth crosses 6 figures. The second rule, at $50,000, the bureau isn't measuring your wealth, it's measuring your relationship to credit utilization. and that relationship can be rewritten faster than almost anything else in your financial life. Level 3. $100,000 net worth. You are 28 and your credit score is 781. You apply for your first mortgage pre-approval. The loan officer pulls your file and the tone of the conversation shifts within the first 90 seconds. Not because of your net worth, which he doesn't ask about beyond a general sense of your down payment, but because your credit file tells a clean, boring, predictable story. 15 open accounts in good standing across 9 years, utilization consistently under 20%, 0 late payments, 1 hard inquiry in the past 2 years. He says the word boring, almost affectionately, describing your file. He says boring is exactly what underwriters want to see. You get approved at 6.1%, the lender's best available rate for your credit tier. A friend with a similar income but a 690 score, 2 missed payments 3 years ago, still aging off his report, gets approved at 6.9% for the same loan amount. Over a 30-year mortgage, that 0.8% difference costs him approximately $61,000 in additional interest across the life of the loan. He didn't have less money than you. He had a worse story, told by a file he stopped paying attention to for 11 months during a difficult year, and the file remembered long after he'd forgotten. You also notice, for the first time, that credit card companies have started sending you offers unprompted. Not applications you sought out, but pre-qualified offers with your name already printed, credit limits already implied, annual fees waived for cards that charge $695 to everyone else. The third rule, at $100,000, the system stops asking you to prove yourself and starts inviting you to participate. The invitations are not generosity. They are the system's prediction that you're profitable to extend credit to. Level 4. $500,000 net worth. You are 33 and you apply for a second mortgage on an investment property. The process is materially different from the first mortgage 5 years ago. The underwriter doesn't ask follow-up questions about your employment history because your file already answers them. Consistent income reporting, multiple lines of credit aged well past the point where they meaningfully affect your score, a debt-to-income ratio that puts you in the lender's most favorable bracket without you doing anything specifically to engineer that outcome. You're approved in 8 days instead of the 6 weeks the first mortgage took. Your score is 814. You also start noticing the asymmetry in how credit treats large versus small obligations. A $9 forgotten subscription that went to collections 2 years ago, an oversight, not a financial hardship, still shows on your report and has cost you, by one lender's explicit admission during a different application, an estimated 40 points relative to where you'd otherwise sit. A $340,000 mortgage paid on time for 5 years straight contributes positively, but represents proportionally far less weight in the algorithm than the small unpaid subscription cost you in penalty. The system does not care about scale, it cares about pattern completion, whether you do the thing you said you'd do, regardless of whether the thing is $9 or $340,000. You dispute the collection account, provide documentation showing it was resolved, and the Bureau removes it after a 6-week review. Your score rises 22 points the following cycle. You apply for a business credit card at this level and receive a $40,000 limit with no personal guarantee required. A structural shift where the lender is now extending trust based partly on the file of the entity, not just the individual standing behind it, a category that didn't exist for you at level 1 and now exists almost automatically. The fourth rule, at $500,000, the Bureau's algorithm starts working in your favor by default, correcting itself faster, extending trust further, and treating small errors as anomalies rather than patterns. Level 5. $1 million. You are 39 and you apply for the business line of credit that arrives approved in under an hour. No documents requested, no follow-up call. The system reads a file that has been clean for 2 decades, utilization that has stayed under 10% for the last 6 years without effort, because your spending no longer approaches your limits in any meaningful way, and a debt-to-income ratio so favorable that the algorithm essentially pre-approves you before a human ever reviews the file. You think, briefly, about the 19-year-old version of yourself putting down a $300 deposit to access a card that charged 26% interest. The mechanism hasn't changed. You have. The pattern you built, slowly, mostly without noticing, across 20 years of paying things on time and not chasing balances you couldn't immediately cover, is the entire reason the system now extends trust at a speed and scale that would have seemed engineered specifically to favor you. It isn't engineered to favor you. It's engineered to favor the pattern, and you happen to be the person who built it. Your credit score is 847. You receive an offer for a card with no preset spending limit, the kind reserved for the file types that almost never default, requiring an invitation rather than an application. You decline it. Not from caution, from the simple fact that you've never needed it, the same way you never needed the watch that costs 10 times what yours does, or the phone that updates every year. The cards and the watches operate on the same underlying signal, visibility designed to be noticed by people who, in your experience, notice far less than the marketing assumes. You close the credit monitoring app without opening the notification. Somewhere right now someone is putting $300 down on a secured card, signing terms they've read twice, buying a tank of gas, and paying the balance 11 days later before the statement closes. They don't know yet that this single repeated action, more than income, more than luck, more than anything dramatic, is what the system will spend the next 20 years quietly rewarding. The Bureau was never measuring your money. It was measuring whether you do what you said you'd do. Do that. Repeatedly. For long enough that it stops being a strategy and becomes simply who you are. The rest follows on its own.